Hello everyone, my name is Luca Facchini and I'd like to give you a small introduction to my professional background. I have over 20 years of trading experience in the markets. I've been developing trading systems, creating programs for position trading, swing, options and day trading on futures, forex and stock market. I've been a money manager and market analyst during the years and also a prop trader. I have consulted with private and institutional clients, developing software for risk control at the prop house level. And again, I work as a commodity trading advisor and a futures broker for over 15 years. I'd like now to move on the next chapter and explain what is a quantitative trading. So I'd like to explain to you now the different trading approaches available to the trader. The main one that everybody is used to is the discretionary trading. People are basically trading based on news or whatever they read on the newspaper the same day or from a tip from the broker or a friend. The pro of this discretionary trading is that it's possible to attain great results in the short term, but the con is that it's very difficult to maintain the same performance day after day, month after month in the long run. It is very mentally challenging. Very few professionals can have trading discretionary with success in the long run. The second approach, that is the one that I prefer, is a systematic, mechanical, or quantistic trading. The pro is that it's easy to manage from an emotional point of view, and if the systems are robust and diversified, with markets and time frames that are different, the trader or investor should have a smoother equity growth. The cons is that it's not easy to create and or find a good strategy, and it's also not easy to maintain faith in the system when we have a drawdown. So basically, it is psychologically difficult to maintain discipline when we have losses even on a trading system. Then there is a third approach that is a semi-discretionary gray box trading, which is a mix of the two methods that I talked about before. So it's like a discretionary with mechanical rules where basically the trader has still a 10% freedom to decide if to take or not to take the signal. Where at the quantitative level, you have to believe in your study, in your background, in your statistical studies, and go ahead and take every trade until when something really major happens. So let's try now to understand better what is quantitative trading and how do we develop strategies. Basically, so we say the discretionary trader basically has an idea of where the market is going to be tomorrow, next week, next month, and is going to invest. But he doesn't know if that decision is actually a decision based on rules that also worked in the past. First of all, whatever worked in the past is not for sure guaranteed that will work in the future. But if we have a strategy, a method that performed well for 5 or 10 years, there are chances that it will also work in the future. But if you just take a trade and you have just a small sample of trades that last maybe 1 or 2 months, that is not statistically significant for a trader to base all his trades in the future and risk capital on that. So the main problem that I saw as a broker and as a mentor is that a lot of people just read 2-3 books, go to a seminar or a couple of webinars, and then they think they can trade based on whatever they learn, based on simple indicators or other methods. The reality is that trading is very difficult, it's very competitive. You're against professionals that they know exactly what they're doing, and if you just trade in a discretionary way, you're going to be killed psychologically more than financially, because the first time you have a loss, you're going to freeze and probably take a huge loss in that moment. So in order to avoid that, we need to think about trading more as a business and basically try to have an approach that is more mechanical in order to keep the emotion away from trading. And one of the things that we do in quantitative trading is to analyze the market and see if there is any inefficiency and try to find a way to take the edge and see if that edge that we see right now worked in the past, or vice versa. We can also look at old data and see if that edge also work in the future. So there are different ways that you can backtest a strategy, and the whole idea is that you have rules that are mechanical, so you have a point of entry, you have a potential target, and a stop loss that is already in the logic of the system, and those rules are going to be applied in a mechanical way, systematic way, every time that rules are actually activated. So it doesn't mean that it's going to work forever. There will be problems in the future because the markets are constantly changing, so you can have a drawdown. But in the same time, if you know that drawdown, by drawdown I mean that we have a period of loss, it can last a month or 3 months or 6 months, is normal, and then you come out of that drawdown or that period of loss. But if you know that for the last 5 or 10 or 15 years, that is part of the rules of the logic of the system, then you're confident that in the future it's okay, it's part of the system. But if you don't know what that rules performed in the past, then the first time you're going to have a drawdown or a series of, say, 5 or 6 losses in a row, you're going for sure to abandon the method or system and try to look for something else to do. So the part that is very difficult is to, of course, create the system, backtest the system, and find this inefficiency. The main problem is also that you have to program the observation that you have done on the market with different kind of coding. So usually you can use like C++ or C#. There are different platforms that also have their own language, like TradeStation has Easy Language and NinjaTrader has their own language. But it doesn't matter. So what you need to do is you have to be able to code and mathematically quantify the rules and then see what happened in the past. And there are different methods that we use to make sure that statistically the system is robust and will potentially be profitable also in the future. All right, so I'd like to speak now more about the quantitative strategy building procedure that I use, and sometimes I use the word we because I'm also consulting with other traders and experts in the field, and sometimes we come out with strategies that are like built together because maybe they have knowledge that I don't have, and vice versa. But so when I say we, that means like me and my colleagues or partners. But overall, the systems are programmed always following a strict protocol to test for robustness and profitability. So robustness means that basically if the system is robust, it means that it's not being over-optimized on past data and it has a good chances to also work in the future. It's not being overfitted over the past data. That's kind of technical, but pretty much is like, with the power of the computers right now, we can find strategies that work well on paper and they will fail in the future because there are too many parameters that are used in order to create that code for that particular system. So you have to be careful not to find a system that just makes you happy, but in reality it'll fail when you trade in real time. So you find goals, you see your own observation, and you have your objective and ideas about a particular market. So let's say you want to develop a breakout strategy, and then you need volatility. So you need to look for markets that are actually moving right now, that have a history of being very volatile. We can use an example of crude oil or natural gas. Those are markets that, generally speaking, that are always moving. So you can start with that and say, okay, let's see if these rules that I see can work. And at that point, you are going to program these rules on a set of rules through any code that you will find perfect for your, for example, trading platform. It depends if you're using, again, TradeStation or you have your proprietary platform and you can use them C++. It doesn't matter. So basically, you have to find a way to make these rules mechanical and be able to test in the past. And usually I test at least 5 years for intraday, 5 to 10 years for intraday systems and swing systems. And for position, I usually go from 10 to 20 years in the past. And I look at that set of data to make sure that whatever I observe now worked in the past, it can also have some validity for the future. So I first test and developed a system based on observation that I have now, and I go to see what happened, let's say, 5-10 years ago. And then if that is profitable and use and show some good sign of robustness, then I'm going to test in another set of, let's say, 5 years of data that is unseen data, so it's out of sample data. So I have in sample to create the system, and then I do out of sample to see on unseen data. Now, if the performance are positive, then I'm going to do some analysis for even more extra out of sample data, another 5 years, using, for example, Monte Carlo simulation or other walk forward analysis to make sure that whatever I observed in the past is still working now and it potentially will work in the future. If everything goes okay, so I see that it worked in the past, I can also reverse the things, like, I can start now and go see what happened in the past, or I can start in the past and see what happened now. But the bottom line is that I want to double test everything and make sure that that set of rules are okay for that market and they're performing consistently during the years. Then at the point, I'll put the system kind of in incubation time. They could be a few weeks to a few months, and now observing in real time, say from today to next month or 2 weeks or 4 weeks from now. And if I see the results are still in line, then I am pretty confident that the system is robust and it's time to go live with real money. Very few people, especially non-professional, are using this approach, and that is the reason why 90% or 95% of the people that try to day trade or trade in general are losing money. This is an example, actually 2 examples of trades on the swing short-term trading system on crude light. The first one is an entry short with a stop order that reached the target with the trailing logic, and the trades was actually activated 10 o'clock Pacific Standard Time and exited around 7 o'clock Pacific Standard Time. The second trade that actually shows a loss is a buy stop also around midnight our time in Pacific Standard Time, and was actually stopped out in the middle of the night. Both trades were entered with a stop, and the second one was actually a stop with a stop, and the market was the order that we used to exit the trading logic for the winning trades. These are 2 examples of the swing that we're trying to capture. It could be any time of the day. In this case, it was in the middle of the night. We didn't capture the upside movement during the regular time, regular session, but the logic of the system is try to look for trades 24 hours a day. These are a couple of trading examples of the day trading system on the Dow. The first one is an entry stop long around 5:30 Pacific Standard Time, and the system, the strategy, was able to capture the majority of the move with an exit on market on close. The second example shows similar trade with a buy stop, this time around 10:30, 10:45 Pacific Standard Time, but the market decided to retrace, and the strategy actually exited with a small loss on market on close. The Dow trading system looks for a breakout to the upside due to bias of the stock market for the last few years to go long. The system uses different indicators to find the best trades. For example, the ADX, the DMI, adaptive moving average, average true range for the trailing logic sometimes, and the RSI for entry points. These are some of the indicators used, plus some pattern recognition for the entry.
So this, for example, is an example of 2009 when we were trading the S&P 500, September 2009, and you can see back then it was using signal, yeah. But anyway, you can see the levels of the plan. These are not specified, but you can see, for example, that the long area was this cluster 871, 869. So this was the support area around 8:30 in the morning, just before Chicago time during the opening, and the market. Sorry, this is Pacific Standard Time. 8:30 Pacific Standard Time. We have the long area 71.69. After the opening 6:30 in the West Coast, we had an area 77.79 that was our area for sell. So if you use the breakout, you would just go short here around 78, and here probably will go long around 70. You just place a stop below this swing and place a stop above this swing, and then you use a target that is like twice the stop. Or there are different methods that you can use for targets. I'm not going to discuss them here, but there are different way to identify a target. But this is just an example to show that the plan worked. The levels worked a long time ago, and they're still working. This is actually the NQ on Sierra chart. Just I think, but you can see this RH, the reversal high. The market went basically one tick from the high of the session, and it went down, and then it tested the reversal low, bounced up, then went down again. Close to this is a kind of a cluster because you have a BL and a PB close to each other. So this would be considered a very strong support area, an area where you could buy. So the market was not able to close below the BL. That means that the market was strong, and because it is above the pivot bias, we consider bullish, and the market finished on a positive note from the rest of the session. Let's see. This I think was a crude light. Again, this is a dynamic level, and above here we have a PP and a RH. So all this area here is considered to be a very powerful resistance. So the market went up around 53.20, 53.30, and it got slammed down. It went through the reversal low, BL, went down to the first dynamic reversal low and target low, missed by a few ticks. And the target low, like I said before, is a good reversal area, but you have to wait for the timing. So buy when one tick above this high, for example, you put the stop here, and the market finished strong for the rest of the session. So you could have like 2 good points with timing again, because here if you use the timing, there's no timing yet. The market just went through the reversal low. You went through the BL. There was never a way. The market never fell this level here. It just went through like like a knife. You have to wait for the market to stop and say, oh, okay, maybe it feels this level. Let's see. Let's try to enter here, or let's try to sell here. Okay. This is still old stuff. 2012 on the mini Dow. Yeah, mini Dow. Again, this is the reversal high cluster, 2 levels. 480 and 70. Market stopped here and went down, and we tested a couple of times, went down. Then it reached a reversal low to the tick up, and kind of felt a little more a couple of times here. But the best reversals are always, like I said before, in the first 2 hours. I always suggest when I teach traders to go with the trend the last couple of hours, especially on the stock index. All right, so this is all I want to talk about discretionary trading, what I like, what I think is a good methodology, a good way to trade if you like to get your hands dirty and trade using your brain. But if you're too tired, you have a job, you don't have time to stay in front of the screen, or you don't want to be emotionally involved in the market, then the second part is the quantitative strategy.
The 6 big advantages of quantitative trading are simple to explain, but they're very important, and they will give you an edge compared to the normal discretionary trader or the beginner or the rookie trader. So we all went through these mistakes as a discretionary traders at the beginning, and I know that by trading or having an approach of trading that is quantitative and mechanical, you will have an advantage over 90% of the normal traders. The number one, I think, is the money management and risk control that the quantitative trading gives you. The way that we try to do the system is try to cover all the different possible scenarios that we see during the trading session, and the stop loss that are the main enemy of the discretionary trader are automatically in the code, so there is no way that you can bypass that. The majority of the people the traders don't have discipline, and when the stop loss is going to be hit, usually they move the stop loss, or actually don't have a stop loss at all. They just have like a mental stop loss, and that is a sure way to destroy your account. It is very important to have a real stop loss in the market that is controlled by machine. It could be a bracket if you do discretionary trading, but usually in the quantitative kind of trading we do is already in the code, so when a stop loss needs to be activated, it's going to be activated. There is no way around that. And the discretionary trader usually doesn't do that, and he will have big losses because he's not disciplined enough to accept the loss when it's time to take the loss. So that is the number one. So the money management and risk control that are inside the quantitative trading is already in the formula. So it will give you an advantage over people that will not respect their stop. So it's number two is the no emotional trading, because usually what we do is having the code traded by the brokers in auto trader, in auto trading mood. So you are not actually placing the trade to buy, sell. You don't have to become emotionally attached to a trade. The system will do it for you. You just have to be disciplined enough to follow the system and don't interfere with the logic of the system. If you believe in whatever you see you created, the statistics that you saw, the backtesting that you did, then you should just carry on and don't think about anything else. The system automatically will follow the rules, and usually the discretionary trader will bend the rules and not respect the stop loss, or take the target too early, so you have a profit. Instead to wait for the right moment, you exit with $100 profit, and maybe you leave another $500 on the table, and then when the market goes against you, you take $500 to stop loss, when in reality you should have taken only $200. So that is another big advantage. So you're not emotionally attached to the trade. Okay, at any level, intraday or position, sometimes you buy a stock thinking that, oh, this is the stock that's going to make me rich, and the stock goes against you, start to averaging down or something like that, and sure enough, the market will just crash against you, and you get paralyzed, and you cannot do anything. You get emotional, attached to that stock, or it could be even a future or a forex or a currency, and then you destroy your account. So that many times with my clients or students. So you also avoid to do overtrading. Overtrading is the third main advantage. Slippage and commission can really chew you up. And so if you do too many trades during the day, you're giving a lot of money to the broker and to the exchange, to the other traders. So if you develop trading strategies that trade maybe once or twice a day or once or twice a week, then you will avoid to spend a lot of money in commission and slippage. Slippage is like, the difference between what you're expecting to be filled or is executed and the reality of the execution. So that is another big advantage. So we already say that selling too soon when you're in profit is one of the main problems that we're having. And so the mechanical system will force you to respect the rules that you impose from your system. And also one thing that I want to mention is that do not believe anybody can tell you where the market is going to be tomorrow, or a week from now, or 6 months from now, because nobody really knows that. The system doesn't know, so just wishing that the market will go to $40 up tomorrow is just wishing. And so we don't wish, we just use mathematical formulas and statistics, and we let other people forecast the future. But if you have an idea that the market is going to be up 40% by next month, then you get emotional and you're not going to give up the trade, and that's not the way to do it, okay? So another advantage that the mechanical system gives you is if you have enough capital, you can diversify your portfolio with different markets to diminish the risk, assuming that each system is constructed in a robust way. So you can have, for example, a system that works on non-correlated markets. So you can have, let's say, crude light, and then you could have an index, and then you can have a currency and wheat or soybeans or any other commodity that are not correlated with each other. So that's a good way to do it. And also you can do it in different time frames. And so you can have a system that works on intraday, 5 to 15 minutes. You can have a system that goes swing trading, working on 60 minutes or 240 minutes. And then you can have a position system that works on daily bars. But the discretionary trader cannot be concentrated enough for more than 2-3 hours. And after that, you start to make mistakes. And for sure, you cannot follow more than a couple of markets, where a machine, a computer, will follow as many markets, as many systems as you want. It's just a matter of having enough capital to sponsor all these systems, basically. So that is another huge advantage that systematic trading, quantitative trading, have over a discretionary trader. And the fifth, so again, the main advantage of the approach of the quantitative strategies is that you can backtest the rules and see what they did in the past and what they potentially are going to do in the future, where if you just trade or invest out of news or a tip, you don't know if that is a system that also worked in the past, okay? So the fact that you can backtest your ideas and show that is robust is something that the discretionary trader cannot do. Maybe he has like just a few, you can have a few months you did well for 6 months with your system, but then you don't know if that system also performed well 6 years ago. Okay, so if the markets are constantly changing, they're not stationary, so the data is always changing. So you don't know if 6 rounds from now, that method that you're using is actually still valuable for the new market. Markets are constantly, now we are in low volatility. Now the volatility comes back 6 months or 6 weeks from now. Many systems or methods that have been working for the last 6 years, where there's a very low volatility, probably they're going to fail. So you have to be able to be flexible and create new systems. So another advantage that you can have over a discretionary trader is that you can use and create new systems based on the current market volatility and not be forced to adapt yourself to apply the old rules to the new market. So if the market changes, you need to be able to have a system that works or a method that works with the new market conditions. And a lot of people, they just get in love with a system or a method thinking that it will work for forever and ever and ever, but nothing works. There are systems that did great 5 years ago, 10 years ago, they work well for 2-3 years, but then market changes, and you know the logic is not working anymore because the markets are constantly changing. So that gives you the possibility to adapt yourself to new market conditions, and so that I think is the main advantage. And so pretty much I think these are the main 6 advantages that that we can see that we can have using quantitative strategies compared to a discretionary trader, and I think that is the best.